Welcome to another one of Professor Karn's accounting videos. The purpose of this video presentation is to discuss financial statement analysis. Alright, so let's take a look here and ask ourselves a basic question. Really, how are financial statements used to analyze a business? And really there's several motivations that we could be looking at here. We think of our financial performance over a particular period. Perhaps we internally want to look at how we did from year to year, or how are we stacking up against a competitor, or how are we stacking up against the industry as a whole. Recall, we can get some data for the industry and our competitors because if they're publicly traded, they have to submit their annual report just like we would. So we certainly can see how we're stacking up, again, against specific companies as well as the industry. Okay, so let's take a look here and see what kind of tools of analysis that we can use. Really three primary ways. First, we can look horizontally. That's a year-to-year comparison of a company's performance during different periods. We can look from a vertical analysis perspective, and that is how once we calculate our particular ratios, we could certainly then compare them to different companies. And then ratio analysis as a whole, we can use numerous ratios and see where we stack up not only internally but also externally. So where we get this information from, we know that, again, corporate financial reports include the annual reports, all the numbers, the report of the independent auditors, any type of management's discussion, analysis of the financial conditions and results of the operations. Obviously, our financial statements will be there, and any notes to financial statements will be there. So we can take all of this information from the financial reports and be able to look over it and then perform the ratio analysis that we're looking at. Okay, so how do we do horizontal analysis to analyze a business? Basically, we're looking at are things increasing or decreasing? But let's take a look, for example, an easy topic. We certainly could say, are sales either increasing or decreasing over a particular time? And if they are increasing, that's hopefully a good thing. But if our cost of goods sold is actually going higher than our sales, then something might be we have to look at there. So just because one amount may be either increasing or decreasing, it doesn't really matter too much. And you can see from the second bullet point here, sales may have increased, but in considered in isolation, this fact may not be very helpful. So you can use horizontal analysis to go from a year-to-year perspective, or you could look at a 5-year period. It really doesn't make any difference. And that allows us to hopefully be able to find and see things that we can look at and potentially look at for ways to improve. So how do we calculate this? Basically, you would prepare the horizontal analysis using the following steps. The first step is you'd have to compute the dollar amount of change in sales, for example. And then the way you would do that would be you would take the later period amount and subtract the earlier period amount. That would be step one. And I'm using sales here as an example. Step two would be for us to divide the dollar amount of the change by the base period amount and multiply by 100. So then that would compute the percentage change for the period. So again, the horizontal analysis percentage would equal the dollar amount of the change divided by the base period amount times 100. And that would get you your percentage that you're looking for. And then you'd have to determine whether or not, looking at all the data, is the increase or decrease, along with other factors, a good or bad thing? And is there any way to either improve efficiency or look at ways to make changes for the better? When we think of trend analysis, that's also another form of horizontal analysis. Basically, you can think about trend being what direction is the business taking. So the way that you would calculate the trend percentages would be to take any period amount, divide by the base period amount, and multiply by 100. And again, you can see then, is the trend going in the right direction, or is the trend going in the wrong direction, and then hopefully make some adjustments to hopefully correct that, or continue on the good path. All right, then we get to vertical analysis, and how do we use that to analyze a business? Basically, what you would use here is when you think about, you look at a particular financial statement, and we would show the relationship of each item to the base amount. So a lot of times you'd have to determine what base amount you would look at. If you think of your balance sheet, you certainly could take the approach of total assets equals total liabilities plus equity. So you would use those as the base figures and then determine what the percentages of each thing were from there. And then if you think of the income statement, you could probably use your sales as your base and then go down the line and see what percentage of each item was a percentage of sales. So you would take the specific item divided by your base amount times 100. When you think of common size statements, you can use that when you're comparing that your performance with another company. And basically, you would just take a look at the percentages. And the reason why you do that would be, you would simply say, okay, well, if everyone starts off with sales being 100%, when you get to net income, is net income 4%? Is net income 10%? And you would be able to compare each item, cost of goods sold, your operating expenses, your net income or net loss, all those things on a percentage basis, and it wouldn't really matter what the dollar value of those items were. You could be comparing a company that was very, very big to a very, very small company, but you'd be comparing apples to apples from a percentage perspective. So it tells you in the third bullet here, it's going to remove the dollar value bias when you're comparing numbers in absolute terms in dollars. So we're not going to see the dollars, we're just going to see percentages and be able to compare and see which one would be a better company from the percentage perspective. Benchmarking is something that's obviously done quite a bit. We want to certainly get in the practice of comparing a company with other leading companies. We would certainly, hopefully, if we're trying to be successful as a corporation, would want to benchmark against a key competitor or either against the industry average. So once we look at those, if we're trying to catch the key competitor, we might be able to see that maybe their cost of goods sold is substantially less from a percentage perspective than ours. And maybe we have to figure out why that is. Maybe we need to find new vendors to get us our merchandise inventory at a cheaper price. So, and again, if let's say our cost of goods sold was substantially higher than the industry average, what are we doing wrong there? We would need to find new vendors. This is something that you want to keep a close eye on. Want to compare apples to apples and be able to say, hey, we can improve inefficiency here. Oh, we're doing great in this area. Or certainly maybe our salaries expense is lower than the industry average. Well, that's a good thing. So we would want to keep building upon that. So really, really have to think about benchmarking as a really good tool when we're thinking about analyzing our financial statements with our competitors and the industry average. Okay, so now we're going to get into more specifics as far as when we think about ratios themselves. There are really 4 different categories when we think about ratios, and they are, and I'll just kind of briefly read each bullet here. We're going to have to evaluate the ability to pay current liabilities and long-term debt, evaluate the ability to sell merchandise, inventory, and collect our receivables. How do we evaluate our profitability, and evaluating our stock as an investment. And again, these are all things that not only internally that we will do, but potential investors will do when they're looking at potentially investing either in our company or a company that's being publicly traded. Okay, so the first one here, the first ratio that we'll look at is our working capital. And basically, it's a very simple formula. Working capital equals our current assets minus our current liabilities. Obviously, as we go through each of these, I'm going to try to make sure you understand as far as a rule of thumb, is a higher answer to the ratio or a lower answer, the better scenario. So obviously, we want our assets to be much higher than our liabilities. It doesn't matter if they're current or long-term. In this case, we're looking at both current assets minus current liabilities. Obviously, we want this to be higher the better. Then we get to the current ratio. This is probably one of the most popular ratios out there. And again, really, are we going to be able to pay what is currently due within 1 year or one operating cycle? That would be our current liabilities with what current assets we have. We certainly want to be able to pay our bills as they come due. And if they don't come due, all these current liabilities due within 1 year or one operating cycle, could we pay them? So obviously, when we take total current assets divided by total current liabilities, we want to get a number that's higher the better. We want the numerator, the current assets, to be higher than liabilities. And I would think that the worst case scenario would be that you would want to have it around, would be 1. Anything less than 1 would not be good. 1 is probably pushing it as not good either, but that would be where current assets equaled current liabilities. So you would certainly hope that it would be a higher number than 1. Our cash ratio is something that's we can prepare to determine, are we going to be able to meet our short-term obligations? And all you got to do is take your cash account, you'd add your cash equivalents, things like your money market, any things that are highly liquid to cash, and divide by total current liabilities. Again, we would want the numerator to be higher than the denominator, so higher the better for this one as well. The acid test or quick ratio is something, what happens if all of a sudden all of our current liabilities came due immediately? Would we be able to take care of them? And we would simply have to take all of our cash, including our cash equivalents, any short-term investments we had, any net current receivables. Remember, accounts receivable net would be that we'd have to take our accounts receivable, we'd subtract out our allowance for bad debt, and we would get our net accounts receivable. So we hope we could turn those into cash pretty quickly. We could probably sell our accounts receivable for, let's say 80 cents on the dollar, get cash quickly. And we divide that by total current liabilities. And again, we want the numerator to be higher than the denominator. So higher would be better again in this scenario. All right, so then we get to the next category, and that's evaluating the ability to sell merchandise inventory and collect receivables. And we have 5 ratios there. We have inventory turnover, days of sales in inventory, gross profit percentage, accounts receivable turnover ratio, and days of sales in receivables. All right, so how are we going to calculate inventory turnover? Basically, we're going to see how many times a company can sell its inventory during the year, and we would simply take our cost of goods sold, and we would divide that by average merchandise inventory, and we would get a number of times during the year that we sold it. Now, think about this. We want to move our inventory as fast and as many times as possible. So higher is better here. But what you want to realize here is that if we would have a low inventory turnover, we run the risk of having our inventory become stagnant, could become obsolete or outdated. And if that happens, then we might have to either sell it at a loss or potentially the inventory could become worthless. So we want to definitely constantly keep our inventory moving and turn it over as many times as possible. And that would be something that would be a primary goal, because again, if we're not making the sales, then our inventory could again become difficult to move or not movable at all. Okay, then we have the days of sales and inventory. And again, here, when we think about it, we would want to take simply 365 days in a year and divide it by the inventory turnover ratio we just calculated in the previous slide. Now here, we would want this to be lower the better, because we want to turn over real quick. So we do not want the number of days of inventory that the company holds it for to be high. We want it to be low. So in this case, the rule of thumb for this ratio would be lower the better. Gross profit percentage. All right, finally some good stuff here about profit. Again, we're going to look at how much of our net sales are we generating in a gross profit. Now remember, net sales minus cost of goods sold equals our gross profit. So again, we want to make sure that this number, we know it's a percentage. It's not going to be, 100%. It's got to be less than that. Well, obviously, there's a cost to a product. So we want it to be as high as possible. But obviously, if we could get, over 50%, we'd probably be doing pretty well for ourselves. Get up to, 75 would be great. Because remember, we've only taken out the cost of the product and cost of goods sold. We still have to pay all of our operating expenses, and we need to make sure we have enough gross profit to cover those, and then still hopefully come out with a net income at the end. Accounts receivable turnover ratio, that is where, when we think about extending credit to our customers, when we think of making sales, we want to hopefully be turning over and collecting our accounts receivable in a very quick fashion. We do not want people taking a very, very long time to pay, because we're going to rely on that cash coming in from the sales that occurred on credit. They need to pay off their accounts receivable, hopefully in a very timely fashion. So the formula for that would be to take our net credit sales and divide by the average net accounts receivable. And again, here, we want this to be higher the better. We want to keep turning it over. We want it to be quick and really, really fast as far as turning it over and increasing the number of times. So people buy on credit, they pay right away, then hopefully they'll buy more on credit and pay right away and keep the cycle going. We also can do the same thing that we did for inventory when we think about the days that were inventory was in the house as far as how long we held it. Now, how long do we have sales and receivables? How long are we taking to collect in days our accounts receivable? So in this case, we would just simply take the 365 days divided by the accounts receivable turnover ratio we just calculated. And again, we want this to be lower the better. A dream scenario would be less than 30 days. That's probably not typical. When you think about it, you're probably going to give the majority of your people around 30 days to pay. Many people may pay within that period of time, but there will be some that will not. So, and then some that may never pay. So again, hopefully we can keep it less than 40 days. Anything higher than 45, we would probably want to look at our credit policies to start trying to enforce a quicker turnaround period. All right, then we get to how we evaluate the ability to pay long-term debt. And we think of long-term debt being bonds. And then we have interest expense along with that. When we make our cash interest payments, we have notes payable, mortgage payable. So what ratios are we going to look at this? We're going to look at the debt ratio, the debt to equity ratio, and the times interest earned ratio. All right, so the debt ratio is very straightforward, and that is how much of our assets are financed by our liabilities. So we would simply take total liabilities divided by total assets. And obviously, we do not want this to be high. We want this to be lower, the better. So we want the numerator to be lower than the denominator and as close to zero as possible. Obviously, that's not going to be zero. It's going to be rare when major corporations are going to have no liabilities. And again, having debt's not a bad thing if you're using it to enhance the operations in an effective way. You just want to be careful of becoming too overwhelmed by debt. So again, lower the better would be the best rule of thumb for the debt ratio. All right, debt to equity ratio would simply show the total liabilities in relation to total equity, and we would just simply take total liabilities divided by total equity. Now, obviously, when you add these two things up, that equals total assets. as far as the accounting equation is concerned. So obviously, when you think about it, we would certainly want this to, again, to be lower the better, but realize that when you think of total liabilities plus equity, that makes up one side of the accounting equation. We hope that the liabilities are substantially less than the equity amount. So the numerator hopefully is a lot less than the denominator. The times interest earn ratio basically tells us how effectively can we pay our interest expense. And we simply would take here the net income plus the income tax expense plus the interest expense, and we divide by interest expense. And obviously, if we look at this here, we want the numerator to be higher. We want this to be a higher the better scenario. Obviously, that means when you have a high ratio, the company is able to meet its interest obligations because hopefully earnings are what? So significantly greater than our annual interest obligations are concerned. So higher the better here. Then we get to evaluating profitability, and we have 5 more ratios here. We have the profit margin ratio, rate of return on total assets, asset turnover ratio, rate of return on common stockholders' equity, and earnings per share. So if you look at the profit margin ratio, again, how much net income of a business earns on every $1 of sales. We want to take net income divided by net sales. Again, here would be higher the better. Pretty straightforward there. We want net income divided by net sales to be a high ratio. Again, we could certainly look at this in comparison to other companies, and we hope that we're going to stack up. If we're stacking up in the industry, then hopefully people are buying our stock price for a nice price. Rate of return on total assets. Remember, an asset is described as something that will hopefully have a future economic benefit, and we want to make sure our assets are working for us to generate a profit. So the formula here would be to take net income, add our interest expense, and divide by average total assets. And again, here we want this to be higher the better. We definitely want our rate of return on total assets to be as high as possible. Asset turnover ratio. In this particular case, we're going to see how much of net sales are we generating for every dollar amount of assets that we invest. Again, assets are something that we have to go out and acquire, and are they generating sales for us? So we're going to take our net sales divided by average total assets to get our asset turnover ratio, and again here we would want this to be higher the better. Rate of return on common stockholders' equity here. Again, and if you look at this, we want to make sure we understand how much net income are we generating for every $1 invested by the common stockholders. So to get this formula, we have to take the net income. Don't forget we have to subtract out preferred dividends because we're only talking about common stockholders here. And then we would net income minus preferred dividends and divide by average common stockholders' equity. Again, we want this to be higher the better. And we want this obviously to be generating as much income as we possibly can for each dollar that the common stockholders put into the business. Earnings per share, we've seen potentially before in the past. Again, we certainly want this to be higher the better. And how much are we generating from an income perspective for every share of common stock? Net income minus preferred dividends divided by your weighted average number of common shares outstanding. And again, higher the better in this case. And this is a common thing we're going to see. You will always see this broken down on a per share basis on the income statement for a corporation. Now, when you think about evaluating stock as a potential investment, we certainly put our money as an investor at risk when we go out and buy stock. Now, the nice thing about this is we could earn really profits of either profits based upon buying and selling the stock, meaning gains and losses. If I go out and buy a share of stock for $20 and I sell it for $70, well, I'd have a $50 gain. That's good. Now, potentially I could have a loss if I'd sell it for less than $10. If I bought it for $10 and sold it for $4, I'd have a loss. So you have risk there. Now, again, the one thing you have to remember is, as a corporate stockholder, the amount you invest is the largest amount you could lose. So if I buy $1,000 worth of stock of GM, the most I could lose is $1,000 less, also including or any type of stock commissions to buy and sell the stock. But you're not held responsible for the debts of the company should the company fail to continue operations. You also have the opportunity to earn dividends. So, when you think about it, not only can you buy and sell shares of stock and generate a profit or loss that way, the company could also declare and then pay you dividends. So it makes sense to put in some time to analyze using ratio analysis if you're considering investing in a stock. Price earnings ratio. Now, what you're thinking about here is you're going to simply have to take the market price per share of common stock and divide it by the earnings per share. Now, obviously, in this case, we would obviously want to look at a lower number for the company when we think of this if we're choosing to invest. When you think about this, we're measuring how much as a stockholder or potential investor we would have to pay for $1 worth of earnings. So in most scenarios, a lower number here would be a good thing. Dividend yield, how much of the stock market's value is actually being returned to dividends, as dividends to the shareholders. Very simple formula: annual dividends per share divided by the market price per share. And in this case, you obviously want your dividend to be as high as possible. So we'd be looking at a high yield return. And then dividend payout, how much from a percentage perspective, when you think of earnings, is given back to common shareholders as cash dividends. Again, rule of thumb, we'd certainly want this to be high. Annual dividend per share divided by earnings per share. Finally, you might want to take a look here and make sure that you might see some red flags when you're doing this type of analysis, when you're looking at financial statements. Things of, are sales, merchandise inventory, receivables, are they going in the wrong direction? Is suddenly earnings the last several years changing drastically in one way or the other, or a trend? Cash flow, not collecting as much cash or having cash come in or leave quicker. What's the reasons behind that? Overextension of debt, too much debt, not a good thing. They might not be able to pay the bills as they come due, which would result in potential financial trouble down the line. What's going on? Why are the receivables not being collected? Why is the average days of receivables in over 60 days? Huge red flag potentially there. Large amounts of inventories. What we said earlier, could the inventory be becoming obsolete or worthless? And then we have to take a loss on that. So what you want to do in the problems for this particular chapter or module that you're working in is make sure you just follow the formulas accordingly, and then be able to, hopefully, if they ask, understand is higher or lower the better, and then be able to compare it not only it may potentially internally, but also with a direct competitor or the industry average as a whole. Thanks so much again for Pearson and their Pearson Higher Education and their willingness to allow me to adapt their PowerPoints to use in these videos.